Paul, how significant could this be?
Yeah, good morning, Guy. Financial repression appears to be alive and well and living in Japan, with the comments that we heard from Finance Minister Katayama today talking about wanting the pension funds to invest more of their money in Japanese assets. Our reporting uncovered that this was a sort of pre-planned statement that she gave at a regular press conference. And the idea being that it's not certain whether this is jawboning or if this is definitely a start of a new policy and a new plan among the Japanese government to get more of those investments that are overseas to come back home. The effect of that, of course, would be to put a bit of a cap on Japanese government bond yields, which would be very handy for the government and also support the yen. Also favourable for the government given the pressure that the yen has been under.
Japan's pension funds control trillions of dollars. And now the government wants that money to come home. Stick around, because what happens next could ripple straight through global bond markets.
More attractive, but they don't really want to do that. So we'll see. It will take a while for pension funds to actually change their mandate. We'll see whether this starts the ball rolling for some initiative that could really change things.
But Paul, what could it mean for Treasuries if you have a switch out of them and into JGBs?
Yeah, so one more reason to be a little bit more worried, particularly about the long end of the US yield curve. Japanese investors hold a significant amount of treasuries, a significant amount of European government bonds as well, for that matter. And were they to reduce their holdings overseas in order to put more into Japanese government bonds, that would, of course, cause a rebalancing effect. And it might set a precedent for other nations to follow as well. So it might be a sort of knock-on effect. I think the bigger concern here is exactly who is buying all of those US Treasuries at the moment. The ownership has changed quite a lot. We know that hedge funds own a lot more, part of the basis trade by shorting the futures and arbitraging the gap between them. That makes them much more volatile and susceptible to kind of flight in times of risk.
Which means the safety net under US Treasuries isn't as solid as it used to be. Hedge fund ownership means one thing in a panic: a fast exit. So, heading into the weekend, where's the real risk hiding?
Very nice. Paul, we're going into a weekend. The US markets will close. Are we going to get more Gulf-related action at that point? Is that the risk that we worry about going into this weekend?
Well, so the trading pattern that we had, remember we had a conversation like this during the war, that weekends were the worst time of the week for traders because they weren't able to, change their positions if there was any kind of flare up in the tension. So people would get very nervous on a Friday and be closing down their positions as much as possible, so there wasn't that much risk at the weekends. I think we're in a different environment right now. The market is still relatively calm, despite the flare-up that we saw in the tensions over recent days, and the reaction in the crude oil price even wasn't that extreme. So maybe not the same as we were before, but people will still be watching their mobile phones for news.